welcome back in the next lecture of microeconomics. So in the last lecture we discussed about the GDP and the related aggregates. We discussed factor cost, market price, cost. Then we discussed the gross versus net, constant versus current price, and all domestic versus national. All these things we discussed, and then we discussed the national income, how to measure the national income, the expenditure method, the production method, the income method, which method we adopt in India for primary sector, secondary sector and the tertiary sector. And then we see the historical evolution of calculation of national income, and we discuss few definitions, private income and disposable income. All these things we discuss. So in today's lecture, this topic is relevant from exam perspective. The GDP base year revision, it was very much in news in 2015. Because what exactly you mean by the GDP base year revision? So GDP is nothing but the money value of all the goods and services produced in the economy in one financial year. So suppose this economy is producing 5 lakh items, which includes the income of a rickshaw puller, which includes the income of a small company, which includes the income of a small shopkeeper, which also includes the income of a 5-star hotel, that also includes the income of the PSUs. So all these things which are being sold are produced somewhere. So the GDP is nothing but the money value of all these goods. But the problem is the calculation, how you will calculate, how you can measure the income of a rickshaw puller. We cannot, because no data is being maintained. The only thing that we can do is suppose take the example of a hotel. In 2010 and 2011, 2012. So actually there are two methods which are being used by CSO, and CSO is doing two types of survey. First one is the annual survey. Suppose in 2010 CSO performed the annual survey. In 2011 again the annual survey, 2012 annual survey. So every year CSO will do the annual survey. But because every year you have to do this survey, so the data collection, the number of households that you will count in the sample, that will be less, that is roughly 50,000. So in India we have 24 crore households. Out of this 24 crore, the sample size is just 50,000 for annual survey. And then there is a after every 3 to 4 years, the CSO will do the detailed survey. In this detailed survey, CSO will do, the sample size is 3 to 4 lakh households. It means roughly 6 to 8 times of the annual survey, the sample size is big. In 2010, suppose there was a detailed survey and annual survey, of course. As per this survey, the income of a 5-star hotel as well as the income of a small hotel. Suppose the income of 5-star hotel in 2010 was 100 rupees. And this small hotel was, all the small hotels, it was 50 rupees. Because in 2010 CSO performed, NSSO sorry, because CSO takes the data from NSSO, National Sample Survey Organization. So NSSO has performed the detailed survey as well. So because NSSO has performed detailed survey, so they have this information that the total sale of small hotels across India from this sample size 3 to 4 lakhs, that is 50 rupees. In 2011 there is no detailed survey, but we have this annual survey. But because 5-star hotel, they maintain their data online, they have computers. So this sale of 5-star hotel we will get, that will be the correct thing. Suppose it becomes 200 rupees. Now the sale of small hotel we don't know, because in 2011 there was only an annual survey, no detailed survey has taken place in 2011. So exactly we don't know what was the sale of small hotels in 2011. So here you have to derive the value, here you have to impute the value, that if the sale of 5-star hotel becomes double, so the sale of small hotel should also be double. So it is 100. But mind it, This is not the exact value. This is not from some survey. This value has just been imputed or derived from this actual value. Because for 5-star hotel we have the data, we have information, but for small hotels we don't have the information. In 2012, if it becomes 300, so CSO will assume that the sale becomes 150. And in 2013, suppose there is again detailed survey. So now we have information of 5-star hotel, not a problem. Suppose it becomes 500. So we will not impute the value from this, but because we have the actual information, the NSSO has confirmed the detailed survey. So by this imputed method, it should be 250. But after calculation, if it comes out to be 220, then NSO will assume that 220 is the sale of these small hotels. So after 3 to 4 years, when NSSO will perform the detailed survey, then CSO will get the actual information. Otherwise, in the mean years, CSO will only assume, CSO will only impute, derive the value from this particular information. This information is known as the direct source. Because directly CSO can get the information. For example, the records of PSUs, the big companies, so they maintain their data online. You can get the data, but for small MSMEs, small hotels, that unorganized sector, from unorganized informal sector, you cannot get the data. So to get the data from these, NSSO will perform the detailed survey after every 3 to 4 years. So this is what the two methods through which the CSO calculates, and addition of these two will give you the total value of the GDP. Coming back to this, what is the need of changing the base year of the GDP? So the thing is, suppose in 2004 and 5, so this is what the total GDP is. That GDP includes few measurable items and few imputed items. For example, the income of the rickshaw pullers, unorganized, informal sector, MSMEs, that cannot be measured, that can only be derived. And then every year we have the data. So in 2004-5, suppose there was a sale of CRT TV. And in 2015-16, the sale of CRT TV is decreasing and the sale of LCD, LED, then we have smartphones. These new items has come. But while calculating GDP, if your basket is fixed, if you are not adding the new measurable items, this basket is fixed, so it means you are only comparing, just like in case of WPI, we discussed there is a basket and the price of this basket will be compared with the price of the same basket in 2 financial years, and whatever is the increase in the prices of the same basket, that will be the value of inflation. So similarly, in case of GDP also, you have to continuously change these measurable items. If these items are fixed, if the basket will be fixed, so you will not be able to measure the value, you will not be able to include the value or the price of these LCD, LED smartphones, because they came after 2008, 9 or 10, and our base year is 2004-5. In 2004-5, there was very less smartphones, LCD, LED and all. So if you will keep the same base year and you are calculating the GDP, this item is fixed and you are calculating the GDP on the basis of only these items, so actually you are underestimating the value of your GDP. That is not the correct value of the GDP, but you have underestimated it because you have not changed your basket. And when the basket will be changed? When you will change the base year. A new basket will come maybe in 2011-12. So that is what the purpose of the change in the base year. So earlier, and this is not for the first time that we have changed the base year. After independence, this was the 7th time that we have changed the base year. From 2004 and 5, we changed it to 2011 and 12. But before 2004-5, what was the base year? It was 99 and 2000. Before 99-2000, it was 93-94. So this is not for the first time that we have changed the base year. This was the 7th time. Now the thing is, again there are some problems to measure the value of the GDP. Suppose what India is doing, India is, in the last lecture we discussed that the following 7 items are not included while calculating the national income, and the 7th point was household services, especially the housewife services. So we are not counting the value or the productivity or the money value of the services given by households. But this is India. And suppose there is some other country, maybe USA, and USA is adding the value of the services or the money value of the services given by the households. So they have increased their GDP and we have not increased their GDP because we have not counted that part while calculating the value of the GDP. So there should be some international body which should prescribe, which should at least suggest that which of the items should be included and which of the items should not be included. Just like when I am saying the GDP of India is this, so that GDP of India means earlier it was GDP at factor cost. But suppose, and factor cost is excluding the effect of indirect taxes and subsidies. But suppose some country is there, for example USA is adding the impact of indirect taxes and subsidy and we are not adding it. So there will be a difference between the methodology adopted by India and USA, which ultimately will be reflected in the actual value of the GDP of these two countries. But we have to compare the value of the GDP. What is the option? The option is there should be somebody that is known as UN, United Nations. So United Nations gives United Nations System of National Accounts. So this UN-SNA, they prescribe that which of the items should be included while calculating the value of GDP or national income and which of the items should not be included. Whether it should be GDP factor cost, which should be the GDP, or it should be GDP market price. It should be at constant price or current price. So all these are prescribed by United Nations System of National Accounts. So in 2008, lastly they prescribed that this procedure should be followed by all the countries. But India and all these countries, we are sovereign countries. So the prescription or the suggestion of UN-SNA, it is not binding on us. But if you actually want to compare the value of Indian GDP with USA GDP, then you have to keep the prescriptions in mind. Of course, if India is saying my GDP is square and USA is saying my GDP is circle, you cannot compare this square with the circle. So that base year or the base things, it should be common. So that UN-SNA prescribed in 2008, and finally India also agreed to some of the prescriptions of United Nations System of National Account, and we changed it after almost 7 or 8 years. The developed countries, it's like an international overview. In developed countries, they change their base year after every 2 years or maybe after 3 years, even after every year, just like UK. So UK changed it from 2010 to 2011 because lot of changes are taking place, just like this online classes. There were no online classes 3 to 4 years back. If you are not adding the value, the sale of online classes in the value of GDP, it means you are underestimating the value of the GDP. So every 2 to 3 years, you should change the base year so that whatever new items are coming in the economy, they will be added while calculating the value of GDP. So this is the international overview, and we discussed the need of the GDP base year revision. So this GDP base year revision was very much in news, not because we have changed the basket, but it was in news because they changed the methodology also. We increased the number of items, correct, but how we were calculating the GDP, this direct and imputed method. So a lot of things, a lot of sectors, they shifted from imputed to direct, and how they are shifted, that we will discuss in the major changes. So the first thing is the product versus production. So this is a major change. So earlier we had product taxes and product subsidy. Then we have production taxes and production subsidy. So all the indirect taxes or the direct taxes, they have been divided into product taxes and production taxes. A new category has been derived, and similarly this product subsidy and production subsidy. This production tax or production subsidy means it is not dependent on the actual amount of the product which you are producing. For example, professional tax. So whatever your income is, whether it is 50 lakh, 500 lakh, whatever your income, you have to pay a fixed 2,500 rupees as the professional tax. So it means it is not dependent on the actual value of the production. For example, we can say professional tax, then we can say on the property, you have to pay that stamp duty. So that stamp duty, that 100 rupees, 50 rupees, 500 rupees, whatever the stamp paper, that is fixed. So this is stamp duty, professional taxes, all these are, they are the example of production taxes. So production taxes and production subsidies, they are not dependent, they are invariant to the value of production. Similarly, in case of production subsidy, the union government is giving some subsidy, some administrative subsidy to cooperatives. So whatever will be the output of this cooperative is not going to decide the value of this subsidy. If you are a cooperative, you will get a fixed amount of subsidy from the government. So this is what the production subsidy means, and this is what the production taxes means. For example, in case of USA, if you have 1 hectare of land, whatever you produce, you will get a fixed amount of subsidy. So that amount of subsidy that you are getting, that agriculture subsidy, is not dependent on your output. If you are producing 100 kg or 1000 kg, you will get the fixed amount of subsidy. So all such type of taxes and subsidy, they are known as production taxes and production subsidy. Then we have product taxes, which is dependent on the value of output. We have excise, we have custom, we have service. So if you are providing a service of 100 rupees, you have to pay 10% of this, which means rupees 10. If you are providing a service of 1000 rupees, then you have to pay 100 rupees as the service tax. So it is dependent on the value of output. For example, in case of product subsidy, we have subsidy to railways, then we have fertilizer subsidy, then we have this minimum support price, this MSP. So minimum support price is what? It is the minimum price assured by the government, that you have two options. Either you will sell to the mandi, but if the prices in the mandi are less, then you can sell to the Food Corporation of India. So if your production is 100 kg, you are getting some subsidy. If your production is 1000 kg, you are getting more subsidy. So when your production is increasing, the amount of subsidy that you are availing, it is also increasing. And that is why these developed countries, they are against our agriculture subsidy. What they are saying? That your subsidies are trade distorting subsidies. In detail, we'll discuss this MSP or National Food Security Act issue under that WTO chapter, international organizations. But this is what the main contention is, that Indian agriculture is given, the government is giving product subsidy under the Indian agriculture sector, and the developed countries, they are giving production subsidy. A fixed amount of subsidy will go to the per hectare of area in case of USA, for example. So it is like the subsidy given by India is 1.25 lakh crores, which roughly equals to $20 billion. The USA agriculture subsidy is $100 billion, but they are opposing our subsidy. In detail, we will discuss under that National Food Security Act. So this is what the product and the production, product taxes, product subsidy, production taxes and production subsidy. This production means it is not dependent on the value of the output. It is invariant of the value of the output. This subsidy you will get. Then we have how this new concept, that is gross value added. Earlier we had GDP. So now a new concept has come, gross value added. Gross value added at basic price. That equals to, this you have to cram, compensation to employees plus operating cost plus depreciation plus production tax minus production subsidy, and then the value of the GDP. GDP equals to this GVA at basic price plus product tax minus product subsidy. And what was the relationship between factor cost and the market price? GDP market price equals to So this is what the relationship was. GDP market price equals to GDP factor cost. In the yesterday's example we discussed 1300 came as the GDP at market price. 1300 equals to 1000 plus 500 minus 200. That was the scenario. Anyways, so GDP market price equals to GDP factor cost plus indirect taxes and minus subsidy. So it is almost same. The new methodology that has come, GDP market price equals to factor cost, all this thing, these factors, they will make the factor cost. Then we have production taxes and product taxes, which is nothing but the total indirect taxes, production subsidy and product subsidy, which is nothing but the total subsidy. If the actual value is going to remain same, then why we have divided into this production taxes and product taxes? The rationale is production taxes, this gross value added at basic price, it can be related to a particular sector. Now sector specific gross value added we can calculate. How we can calculate? Because production taxes and production subsidy is being given to a particular sector, professional tax. Only professionals have to pay. For example, if you are saying that two cooperatives, you are giving a subsidy. So to all the cooperatives, the production subsidy is being given. So we suppose we have the textile sector, we have the construction sector. So to construction sector, if they have to pay some extra tax, or if the government is giving some subsidy, so that sector specific gross value added can be calculated. So gross value added will be a concept of sectors. If this is the total GDP, so this is one sector, this is second sector, so this is third sector, fourth, fifth, sixth. So sector specific GVA you can calculate. And then you can compare that sector with the same sector of some other country. Just like gross value added of construction can be compared with the gross value added of the USA. The gross value added of agriculture can be compared with the gross value added of the USA, because here you are measuring only production taxes, which is not related or dependent on the actual production. To sector you are giving this particular subsidy. This sector has to pay this particular tax. So you can compare the gross value added of the sectors, and then you can compare these sectors. And finally, by adding all these sectors, all gross value added basic price of different sectors plus the product taxes and minus the product subsidy, finally you will get the same value of the GDP, which is prevalent in the market. This is what we have. The only reason of dividing this indirect taxes into production taxes and product taxes was to get the value of GVA specific to the sectors, so that rather than comparing the full GDP, you can compare the sectors with different countries. We can say the value of the GDP at market price is going to be same. What was here, it will be 100% same here. No changes has been done because of this. This is known as hair splitting. You have just divided the hair. Earlier this was the hair, now it is like this. It's just a hair splitting. Nothing has changed. The only thing is the methodology. The method you were using earlier, it has changed to this thing. So this is only a methodological change. Of course, again we are going to discuss, we have changed the quality also, the quantity also, but this is going to change only the quality. The methodology adopted by the CSO, it has changed. So this is what the production and product, and why we divided into production and product, so that to compare the sectors. Then we have this MCA 21 program. Earlier, whatever number of industries that we have in India, so earlier every year RBI was doing a survey, and that RBI survey was done only on 2,500 companies, and whatever was the production of 2,500 companies, RBI was generalizing it across all the companies, which includes MSMEs and all, and finally they were giving the data to CSO, and CSO was calculating the value of the GDP. But now it has been changed after the GDP base year revision from 2004-5 to 2011-12. In this new GDP base year methodology, now RBI survey will not be used. We have Ministry of Corporate Affairs 21st Century program, under which more than 5 lakh companies, they are paying their income tax online. So we have a very good database which is with the Ministry of Corporate Affairs. So now the source of information, the CSO was dependent earlier on the RBI survey. So now it has been stopped, and CSO will collect the data from MCA 21 program of Ministry of Corporate Affairs. Think about this qualitative shift. Earlier it was dependent on 2,500. Now it is more than 5 lakh companies. So more accurate figure. Of course, the number of companies in India is much more than 5 lakh. But it is a huge shift from 2,500 to 5 lakh companies. So more refinement of the data collection in this GDP base year revision. So this is MCA 21 program. And the GDP factor cost. After this revision, if I am saying if the GDP of India is, for example, $2.1 trillion. When I am saying GDP of India is $2.1 trillion, it means GDP market price is $2.1 trillion. It is not GDP factor cost. Earlier it was GDP factor cost by default. When just like yes, in the last lecture we discussed key national income. So national income is nothing but NNP-FC. It was not NNP-MP. So that GDP market price is now the GDP. Now the GDP can be again further divided into nominal GDP and real GDP. That is different. Nominal and real means at current price or the constant price. So at current price the GDP of India is $2.4 trillion. So that value can be different, but by default GDP means GDP at market price. Then we have the enterprise approach versus establishment approach. Suppose this is a big company, Maruti is there, and this Maruti is having 5 different branches. The headquarters of Maruti is based somewhere, and there are 4 different branches of Maruti, maybe based in the same city or the different city. So they are known as establishments, and this is known as the enterprise. So collecting the data from different establishment, there are more chances of error, because whatever data is being sent from this establishment will be consolidated by this headquarters. The data will be refined, and earlier CSO was getting a data from the establishments without any refinement. But now for big companies, the CSO will collect the data, the NSSO in that surveys, which is finally giving the data to the CSO. So now they will get the data from the enterprise. At least for a big company. But for small companies, there are chances that these establishments are independent. They are not sending the data after every quarter, after every year. So for small enterprises or companies, still establishment approach will be followed. But for big enterprises, big corporations, MNCs, the data will be collected using enterprise approach, because in enterprise approach, refined data you will get. In case of establishment, maybe the data collection will not be refined. So this is what the enterprise approach versus establishment approach. So the new approach which has been started after GDP base year revision. And the next one is the share of manufacturing has increased. This is any economy. In any economy there are 3 sectors. We have agriculture, we have manufacturing, and we have service sector. Can you tell me the share of agriculture sector in the GDP, and the share of manufacturing sector in the GDP, and the share of service sector? Majority of us, they will say that agriculture is not giving 14%. Agriculture means agriculture and allied activities, and we have the manufacturing, or we can say the industrial sector, and then we have the service sector. So agriculture, before this GDP base year revision, this agriculture was giving 14%, you are right. But the number of items that earlier you were considering under this service, if some of these items, for example this, if now these items they are being counted under agriculture, so the share of agriculture has to increase. So after GDP base year revision, in just one day, because earlier the methodology was different, and after GDP base year has been revised, the methodology has changed. So now they have increased it to 17%, because now more items from the service sector, they will be regarded as a part of agriculture. Similarly, from the perspective of manufacturing, more sectors, for example, we have corporate social responsibility. Then once the item is shifted from the manufacturing hub to the headquarters, there will be a lot of marketing activities, sale activities that takes place. So earlier all these activities, marketing activities, they were considered under the service sector. But after base year revision, whatever is happening, the marketing, sale activity, that will be counted under manufacturing only. Similarly, the corporate social responsibility, that will be counted under manufacturing. So you have decreased the share of service sector at, or you have increased the share of manufacturing sector at the cost of service sector. The service sector, which was earlier contributing more than 60%, 63, 64%, it has now decreased to 54%, and the share of the manufacturing has increased to 29%. So the only reason is, actually earlier also the GDP was suppose 100, now also the overall GDP is 100, but only the share of these three sectors has increased or decreased. The reason is the change in the methodology. The number of items earlier that you were considering under service, now some of these items will be counted under manufacturing and some of these items will be counted under agriculture. But on the ground nothing has changed. If earlier Indian GDP was this, today also the Indian GDP is this. So this is what the basic, but again there is a problem. The problem is, few economists like Raghuram Rajan, they said, listen, earlier the GDP growth, but suppose this is 2012-13 and this is 2013-14, for example, as per the previous GDP base year, it was 2004-5 and these number of items you were considering while calculating the GDP. After changing the base year to 2011-12, suppose you have added these new items, but the problem is the same set of items you are adding in 2012-13 and 2013-14. Same LCD, same LED, same smartphone you have added here, same LCD, LED, smartphone you have added here. So suppose earlier your GDP was 100 rupees, this is the old method, and so this will be the new one, and in 2013-14 your GDP was 105, so GDP growth was 5%. And as per the new methodology, as per the new GDP base year revision, you have added these items. So suppose your GDP becomes 105, rupee 5 you extra added, and the same set of items you have added here, so maybe it becomes 1 rupee extra for this, so it is should almost is 5%. So the GDP growth should be same even though you have changed the GDP base year, because the new set of items will be counted here also, the new set of items will be counted here also. But suppose CSO came and they said that earlier our GDP growth, it was 4.7%, and now after changing the GDP base year and all, it has become 6.4%, 6.9% even at the market price. How it is possible? It is not possible, because the same set of new items you have added, then how can there be so big change in the GDP? Similarly, the manufacturing sector, this was the major one, because we have national investment, national manufacturing sector, under which we are making the zones, special zones, national manufacturing investment zone. So earlier the growth of manufacturing was negative and you have increased it to more than 5%. How it is possible? Because all other GDP is only one way to measure the growth, the development of the economy. There are few other sectors, few other indices, just like we have IIP. All this we will discuss in the industrial unit. IIP, index of industrial production, which also calculates whether the economy, whether the industries are increasing or decreasing. Then we have the infrastructure investment in infrastructure sector. Then we have PMI index, which measures the increase in export or decrease in export. So all these, they were negative. Then we have investment rate. So these were negative, investment rate was decreasing. This is the other sectors which are depicting the health of the economy. And suddenly you came and you said our GDP after GDP base year revision has increased from 4.7% to 5.9%, 6%, 6.5%. This is not possible. It is contradictory. And few economists like Raghuram Rajan, they criticize the GDP base year revision on the basis of this, that other indices they are still negative, investment rate is decreasing, savings rate is decreasing, and but on the other hand you said our GDP has increased. So that created a question mark over the methodology that were used by the CSO for the GDP base year revision. So this is more than enough from exam perspective that is related to microeconomics. Thanks a lot.